All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Thursday, everybody. Today's March 27th, 2025. The top story this morning, another note from TD Cowen yesterday about Microsoft and data center cancellations. This is the second one in a month, and it's getting worse. The note came out yesterday from TD Cowen that said 2 gigawatts of data center capacity has been canceled by Microsoft. Cue some guy somewhere saying 1.21 gigawatts. That being said, let's understand what's really going on here, guys. It was just in February that TD Cowen came out with an analyst note that said several hundred megawatts were being canceled. Now we are at up to 2 gigawatts a month later, which, by the way, if you don't habla a watt, that means twice as many data centers have been canceled in just the last month. And TD Cowen actually specifically said some of these cancellations and some of these projects Microsoft is walking away from happened within the last month. Microsoft is officially the first one to blink in this great game of Capex Chicken. The market does not want to acknowledge this is happening. The banks, especially the underwriters of the Coreweave IPO, they're like, no, not until we dump our bags on Friday. Nobody even acknowledged this note. Quick, issue some kind of a press release with these carefully chosen words that say, oh, we're very happy with our CapEx and we are well positioned to achieve blah, 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 increasing demand. Not denial. Another one of those non-denial denials coming from Microsoft. Guys, let's face fact, they overbuilt compute capacity. I think anybody but Jim Cramer and maybe this banana guy, that angry piece of fruit, anybody besides them is ready to acknowledge that we overbuilt data center capacity, that this insane demand that was going to go on forever, that was a pipe dream. It was never real. It was smoke and mirrors created by accounting gimmicks, by companies that were investing in other companies that had no path to profitability, if even a product at all. In other words, the AI bubble is popping in real time. We're watching this happen now. And I said it for a while there, the Coreweave IPO will mark the top. Well, it looks like the top is already in. But that Coreweave IPO, it starts trading tomorrow. Now, look, I don't think it could happen, but I don't think Coreweave's stock is going to like instantly crash at the open. You've got underwriting banks who pretty much signed up to say, we're not going to let that happen. We'll step in and buy these shares if nobody else does. It's about what happens in the weeks and months following the IPO. So this isn't going to be an instant cliff that we fall off of. It's going to be more of a stare down. But things really do not look good for the Coreweave IPO here. And this note from Microsoft is just the icing on the cake here. Those data centers that were canceled were in the US and Europe, some in the last month. And also important to note that Google and Meta stepped in to scoop up that canceled capacity. So that kind of tempers the enthusiasm for the decline in the demand, right? Microsoft is the only one that's doing this right now. And as soon as they did it, Google and Meta were like, yoink, we'll take it. So Google and Meta are still content to feed cash into this money-burning furnace. My guess is Google will be the next one to blink, maybe Amazon. Zuckerberg and Meta, those guys are still blowing billions of dollars on the metaverse, which is going to pay dividends any day now, right? Maybe. So I think Meta will probably be the last one to pull back their CapEx, but clearly Microsoft is the first. Also, speaking of that Coreweave IPO, yesterday the story broke in the Financial Times that Coreweave had triggered a technical default on their loans from Blackstone. Remember the loans, the $2.3 billion that was collateralized by GPUs? One of the first videos I ever did about the AI bubble with Samantha LeDuc and how conveniently timed it was for NVIDIA's earnings. Well, there was a little clause in that contract that said those chips, that collateral had to be in the U.S. Well, Coreweave took that money and they spent it to build out data centers in Europe, as in not in the U.S., as in they have violated the terms of the loan, as in they triggered a technical default when they did that. Now, I'm using the term technical default here because they didn't miss any payments. They just violated the terms of the collateral. Now, here's the point of this, though. Coreweave is saying, oh, this was just an administrative error. It's no big deal. Blackstone is saying we're not going to trigger any kind of like repayment clauses or any fines. Of course, Blackstone isn't going to do that. Blackstone is one of the firms that's selling shares into the IPO, and they're not going to do anything that might drive down the demand for what they're selling. But then again, CoreWeave probably knew that, didn't they? When they decided that they were going to spend this money on data centers in Europe in violation of the terms of their loan. Now, don't you think an entry-level paralegal assistant could have spotted like, hey, guys, there's this paragraph here that says U.S. only, and you're using this borrowed money to spend in Europe? Don't you think somebody at this AI visionary company run by geniuses and, oh, my God, these guys are so amazing. Look what they've built from nothing and unicorns and rainbows. And then they're like, well, gosh, we don't actually read our multi-billion-dollar contracts. Oh, sorry. So what is it? Are these guys geniuses or are these imbeciles who can't read fine print? It seems like it swings back and forth depending on what they're selling at any given moment. Either way, though, bad. This is major egg on the face of CoreWeave just 2 days before their IPO. Look, these are guys who play fast and loose with the rules. I mean, do they break the law or not? They're always walking that fine line, and people should know this before they invest in the company. Oh, and there's also an article in CNBC this morning about their depreciation problems. You see, CoreWeave owns 250,000 of the H100s, the Hopper GPUs. That's the previous generation. Now we're into the Blackwell generation. And, well, CoreWeave has a problem. Those assets, collateral for their loans, they're decreasing in value. And Jensen Huang at their little GTC event that they had last week may have let slip that by the time Blackwell starts shipping en masse, you won't be able to give away Hoppers. That is exactly what he said. Now, of course, ever since he said that, everybody's walking it back like, oh, no, he was kidding. Don't worry. Hoppers are still awesome and demand is still insane. Even though the CEO of the company that makes them said soon you won't be able to give them away. That's not such good optics for a company that owns 250,000 of them, makes money renting them out, and, by the way, owes billions of dollars against them. It's also not so good for the people who loan them those billions of dollars because those things you won't be able to give away is the collateral for that debt. Guys, this is where money goes to die. I don't know how to tell you that, but things not looking so hot for that IPO. It starts tomorrow. For better or worse, it's coming. We've all seen it coming. Tomorrow it arrives. Speaking of arriving, Trump's 25% tariffs on autos arrived just yesterday, so that is official. There were some carve-outs under the USMCA for American-built parts that are sent to factories in Mexico or Canada. The value of those parts would be deducted from the tariff total. But that being said, this is really going to jack up the prices of some vehicles, guys. 25%. When you think about like an F-150 starts about $80,000, we're talking a $100,000 truck now. All right. Now, I put a video out yesterday with my buddy Tom from Car Concierge Plus that said car prices are going higher. And I got to say, this is the most negative comments I've ever gotten on a video, on that video about car prices going higher. People did not like the thought of more expensive cars. And look, I don't like the thought of it either, but 25% tariffs on new vehicles, that sure as heck isn't going to make them cheaper. And also the fact that we have underproduced vehicles by several million a year since 2020 now. We've now got about a 5 or 6 million vehicle deficit in this country, which means there's fewer used vehicles coming off of lease and entering the used vehicle market, which means a shortage of used cars on top of those tariffs on new cars. Either way, guys, that means more expensive cars. Even if people can't afford them, it also means companies are going to make less of them. And we're already seeing a lot of companies cutting back production because they're not going to make cars people can't afford. They're not going to lower the prices to a loss. Fewer cars hitting the road. Now, look, we don't do echo chambers, guys. If I get them wrong, I expect to be called out on them. But I think a lot of people reacted to the title and didn't really get into the nuance of what was being said in that video. But check that one out. Also, shout out to my buddy Tommy. Thank you, brother, for coming on the channel once again. And Tom's track record on car prices has been pretty freaking fantastic over the last couple of years. Also going on this morning, guys, GameStop. That didn't take long. Yesterday, GameStop announced that they are issuing convertible notes to buy Bitcoin just a day after their board approved them buying Bitcoin. So Michael Saylor's infinite money glitch is now Michael Saylor and GameStop's infinite money glitch. We've got gold pushing another all-time high today. Steel mills closing in the UK because tariffs, dogs and cats living together. mass hysteria. Why don't we shrink my big melon of a head and let's see what's going on in these markets this morning? And remember, guys, don't forget that like button for the YouTube algorithm and that subscribe button if you're new here, because we do this one every day. So come on back and have your coffee with the melon heads as we go through markets. And right now we have got the S&P is down by 10 points, a little bit in the red here this morning, 0.2% lower ahead of the opening bell. The Dow is virtually unchanged, down 2 points, 0.01% lower. It was positive for most of the morning. Now we are in the red. And the NASDAQ is leading the way lower, off by almost 0.25%, 48 points to the downside for the tech-heavy NASDAQ. Looking over at the dollar, we've got a slightly weaker dollar this morning, off by 17 basis points, but still above 104 at 104.37. Looking over at the bond market, we got a mixed bag for yields, but higher on the longer end. Once again, the 30-year Treasury, 4.718. That's up by about 3.5 points this morning. The 10-year Treasury, 4.368. That's up by 3 points. The 2-year, meanwhile, is down by a point and change at 3.996. And the 1 month is off by a fraction of a point at 4.291. By the way, guys, keep an eye on the bond market. My moderator, Mish, he caught wind of something, and I have learned to trust Mish's instincts when it comes to these things. There's a lot of things being said about repo facilities, about liquidity concerns heading into the end of the month. We're seeing repo usage over in the UK is on the rise. There seems to be something brewing in the bond market. I don't know what it is, and I haven't been able to quite get my finger on what's going on. But the next couple of days, keep your eye on that 2-year and that 10-year yield. Moving on from there, looking at the commodities board, we have got gold is higher by another $27 this morning, $3,046 for spot gold. And at one point this morning, we hit $3,056 for spot gold, which would be an all-time high, another 0.89% higher. By the way, front month gold contracts hit a high of $3,094 this morning, almost $3,100 for gold. Guys, gold continues to rip, and silver's getting in on it as well this morning, $33.87 for spot silver. That's up by 22 cents or 0.65% higher. I like the shiny. Copper, though, down a little bit, 1.4%. That's off by about 7%. Possibly tariffs taking a chunk out of copper this morning. Platinum, meanwhile, is at $965. That's off by about $3 or 0.38% lower. Palladium is 0.5% higher, meanwhile. And crude oil essentially unchanged here, $69.67. That's up a couple of pennies for oil this morning. Let's take a look at the gold chart, though, because, I just love to see the shiny making new all-time highs. Not quite an all-time intraday high. The all-time high intraday for spot gold, this is front month future contracts, was $3,057, and that was hit on March 20th. Today, we went as high as $3,055. So we haven't quite hit a new all-time high in gold, but we are flirting with that level. Now, also worth pointing out, guys, there's something changed recently on the Atlanta Fed's GDP Now tool. Shout out to Mish, who caught this one this morning. You may notice right here, they've put a little bit of a new feature on the GDP Now forecaster, the gold adjusted GDP Now. We were talking yesterday about how the influx of gold coming into the U.S. because of tariffs is somewhat artificially driving GDP lower. It's not artificial. I mean, the GDP formula is the formula, but I just don't think gold coming into the country is necessarily a bad thing, and that's why I say artificially lowering GDP. But it seems like the Atlanta Fed is kind of along that same line of thinking, because they've now created this dotted line that subtracts the amount of gold flowing into this country to try to forecast what GDP is. And if you account for gold, GDP is positive, but just barely at 0.02%. So either way, economic growth is slowing. It's right around flat to no growth if you don't count gold. If you do count gold, it is deep in the negative. Looking over at the price of Bitcoin this morning, $86,681. That's off by a few $100 from yesterday's levels as priced on Coinbase, still above the 200-day moving average. It seems that GameStop news did not do much for the price of Bitcoin, and we've got more GameStop news this morning. GameStop to offer $1.3 billion in convertible notes ahead of the Bitcoin investment. Look, guys, this is exactly what Michael Saylor does. There are these no interest rate bonds that they're offering that they pay no interest. All it is it's a bond. You loan money to GameStop, and in 2030, they will give you shares of GameStop in exchange for redeeming that bond. And what is GameStop going to do with that money? They are going to go buy Bitcoin. We've seen MicroStrategy does this a lot, and now GameStop is getting in on this. So this is $1.3 billion they're going to raise. That's on top of roughly $500 million that GameStop already has in cash. So, I mean, it looks like they're going to be buying somewhere around $1.5 billion to $2 billion worth of Bitcoin here. Now, GameStop stock is not taking this news well. We are down 10.25% this morning, trading at 25.43. We're off by $2.93, basically giving back all of the gains we got yesterday. This is because these convertible notes are dilutive to shareholders, right? These bonds that they're issuing are redeemable for new shares of GameStop. So that value comes out of the existing shares. And GameStop is not that valuable of a company. They got a market cap of $12.6 billion. So this is a not insignificant dilution of existing shareholders. The idea is this investment in Bitcoin will make shareholders more money to offset that. Of course, that is dependent on Bitcoin prices. So GameStop is pretty much a Bitcoin company now, guys. They are no longer a used game retailer. They're a Bitcoin company, and they get all the good and all the bad that comes with that. Prepare for winter. That's all I can say. All right, let's talk about the Microsoft projects here. Microsoft abandons data center projects, TD Cowen says. Second time in a month that we have had a story like this, and the numbers keep getting bigger. Microsoft has walked away from new data center projects in the U.S. and Europe that would have amounted to a capacity of about 2 gigawatts of electricity, according to TD Cowen analysts. That's about 2 nuclear reactors worth of power, guys. This is a lot of data centers they're walking away from. And this TD Cowen analyst attributed the pullback to an oversupply of clusters of computers that power artificial intelligence. All right, read that again, that last phrase, guys. All right, the pullback is attributed to an oversupply of clusters of computers that power artificial intelligence. Not insane demand, not demand that will only ever increase. Not we don't have enough compute. Hide your kids, hide your wife, sell your house, whatever. Do whatever you got to do to buy more GPUs. Nope, they're saying we built too much of this stuff. In other words, what Jack has been saying since 2023, but I digress. The analyst who rattled investors with a February note highlighted leases Microsoft had abandoned in the U.S., said the latest move also reflected the company's choice to forego some new business from ChatGPT maker OpenAI, which it has backed with some $13 billion. Microsoft and the startup earlier this year said that they had altered their multi-year agreement, letting OpenAI use cloud computing services from other companies, provided Microsoft didn't want the business itself. But it's okay, Microsoft and OpenAI, they're still going to be friends, and they're going to talk all the time. It's going to be great. Microsoft's retrenchment in the last 6 months included lease cancellations and deferrals, the TD Cowen analyst said in their latest research note on Wednesday. Alphabet's Google had stepped in to grab some of the leases Microsoft abandoned in Europe. The analyst wrote, while Meta Platforms had scooped up some of the freed capacity in Europe. So that's important as well here. They're saying Alphabet and Meta, Facebook and Google stepping in to buy some of this capacity that Microsoft is walking away from. Emphasis some. They did not buy all of that capacity. So maybe there is some unused capacity here. I don't know. Thanks to the significant investments we have made up to this point, we are well positioned to meet our current and increasing customer demand, a Microsoft spokesperson said in a statement, adding that the company last year added more capacity than any other year in history. In other words, Microsoft is not denying this report. All right, they're making this wishy-washy statement. Thanks to all these investments, we're well positioned, increasing demand. Yay, us. Not denying the story. Very big news here. By the way, this is in Sherwood News. I've never heard of this website before, but they're adding a little bit more color. They actually added a clip here from this TD Cowen note. Microsoft has both walked away from 2 gigawatts of capacity in both the U.S. and Europe in the last 6 months that was in the process to be leased, and has both deferred and canceled existing data center leases in both the U.S. and Europe in the last month. This is not something that happened 6 months ago. This is an ongoing thing. And when TD Cowen went from a few hundred megawatts back in February to 2 gigawatts this month, that means this is accelerating as time goes, not this is not a one-off, guys. This is getting even worse. And this comes on the same day, yesterday, as this article in the Financial Times. Coreweave triggered defaults after breaching terms on a Blackstone loan. The U.S. cloud company seeking a blockbuster $32 billion IPO had to remedy serious administrative errors in December. Was it an error? Was it really, though? Was it? I don't know. Coreweave, the cloud computing group seeking to launch a blockbuster $32 billion IPO, violated several key terms in a $7.6 billion loan last year, triggering a series of so-called technical defaults. The U.S. company, which leases computing capacity to tech groups building AI models, disclosed in the exhibits to its IPO document that it had to ask its biggest lender, Blackstone, to amend the terms of the loan and waive these defaults in December. This is stuff that's buried in the IPO filing, guys, when the company's like, we dare you to buy this stock. This is the kind of stuff they disclose, but nobody ever reads these things. Thank God Financial Times did. While Coreweave did not miss any payments under the loan facility, it made a slew of serious administrative errors, which stemmed from beginning to use the financing to expand into Western Europe. This clashed with key terms that, in effect, restricted the debt's collateral to the U.S. And that's the thing. They spent the money on data centers in Europe when they were supposed to be limited to the U.S. Is it really an accident? When you borrowed $7.6 billion, do you really just get to say, oh, we didn't check the fine print, our bad, we'll do better next time? Especially these people that everybody's acting like they're such geniuses and they've got the market beat. And oh my God, they're so forward thinking. And yet they can't be bothered to hire an entry-level attorney or paralegal assistant to read the fine print in their contract right before they IPO. Come on, guys. And Jim Cramer's on CNBC yesterday. Oh my God, by the way, Jim Cramer was like making love to this company in real time. It was just so glorious. I mean, like just the best possible outcome, in my opinion. But Jim Cramer said they put the money in the wrong account. This was nothing in terms of this Financial Times article. Jim Cramer just bold-faced lying on the air on CNBC yesterday when he was talking to Mark Faber. No, they didn't put the money in the wrong account, Jim. They spent the money on the wrong continent when the clauses in the contract clearly stated U.S. collateral only. So anyway, Jim Cramer's uber bullish Coreweave. Do what you want with that little tidbit of information. Also in CNBC this morning, more on this Coreweave IPO. The concern with Coreweave's 250,000 NVIDIA chips ahead of its IPO. Look, guys, let's make this clear. Almost all of Coreweave's chips, this 250,000 GPUs that they spent $8 billion of debt plus all that Magnetar money on it, they're old. They're now a few years old. They're 2-3 years old, 1 year old. They're hoppers. The Blackwell generation is coming out. They've got another generation that they claim is coming out. I forget what they're calling the next one. But they're old and they're obsolete. And here's the problem, guys. It's collateral for their debt. And some of the things that Jensen Huang has been saying says, well, that collateral probably not going to hold its value. Again, something I've been saying since August of 2023. These days, NVIDIA CEO Jensen Huang says that his company's Hopper chips are getting blown out of the water by their successors, the Blackwell generation of GPUs, which have been shipping since late 2024. Hopper chips are fine for some circumstances, but not many, Huang joked at NVIDIA's GTC conference last week. Imagine being the underwriters of the Coreweave GPU when Jensen Huang said that at GTC. They're like, oh my God, we just lost another $100 million. In a reasoning model, Blackwell is 40 times the performance of Hopper. Straight up, pretty amazing, Huang said. This is the kind of stuff he says every day. I said before that when Blackwell starts shipping in volume, you couldn't give Hoppers away. That's pretty profound. You can't give Hoppers away. Now, everybody in the press is trying to be like, oh, he was just kidding. It's just a joke. Pay no attention to what the CEO of this several $trillion-dollar company just said. Buy the Coreweave IPO. He said, you couldn't give Hoppers away. Well, Hoppers is pretty much all Coreweave has. They borrowed $8 billion against it. They're already losing money on it. They're now 2 years old. How's that collateral holding up for you? How is that rapidly depreciating asset? That's great for NVIDIA, which needs to find ways to keep selling chips to the companies committed to the AI race, but it's bad news for GPU clouds like Coreweave. That's because the New Jersey company models the future trajectory of its business based on how much it anticipates being able to rent NVIDIA chips out for over the next 5 to 6 years. Yeah, if Jensen Huang is already saying you can't give away hoppers and they want to rent these out for 6 more years, well, first of all, good luck even making them last that long. At the rate they run these things and how they overclock them and heat them up, this thing's not going to last 6 more years. Sorry, it's already 2 or 3 years old. They'll be lucky to get 5 out of it, let alone 7 or 8. All right, but enough about the AI bubble. Let's talk tariffs now. Trump announces 25% tariffs on all cars not made in the United States. It is official. He just announced it yesterday. Weren't we talking this week about how sector-specific tariffs were going to take longer to get here? Like, as in not on April 2nd, much later than that? Well, here we are on March 26th, and they've already happened. It's almost like we're just making this up as we go, and nobody really knows WTF is happening with tariffs. President Trump on Wednesday said he would impose 25% tariffs on all cars that are not made in the United States. Trump said there is absolutely no tariff for cars that are built in the United States. The new tariffs were codified in a presidential proclamation that Trump signed in the Oval Office. They will go into effect on April 2nd, and we start collecting on April 3rd, he said. Trump White House aide Will Scharf said the new tariffs apply to foreign-made cars and light trucks. He clarified that they come in addition to duties that are already in place. Okay, that's potentially big because they're also talking about, I don't know how true that statement is, but they did just put 25% tariffs on Canada and Mexico. Does this mean a 50% tariff on cars? It's unclear here. So this is worth looking into. Scharf said the tariffs will result in over $100 billion of new annual revenue in the U.S. Okay, sorry, guys. Gigi just came in and said, check your phone, Coreweave. Oh, okay. We're going to finish the tariff story, and then we'll get back to this. Sorry, I've got somebody in my ear. All right, the tariffs. Over $100 billion of new annual revenue for the United States. Congratulations, guys. That $100 billion of new revenue for the U.S. government, that's coming from your pocket. Or if you buy a new car, you're going to pay that. That's the thing. Like, look, tariffs are destructive, guys. Trade wars are wars of attrition. They're celebrating how much money the government is going to collect. The thing that's important to understand is that's coming out of your ass. That's not coming out of some Mexican car factory that may eventually sell fewer cars, and eventually they may move production back to the U.S., but the pain of those tariffs will get here first before any of that happens. Specifics about the proclamation were not immediately clear, and most vehicles are assembled from thousands of parts that may originate from dozens of different countries. Speaking of tariffs also, guys, we got tariff hit British Steel confirms furnace closures. This is a Chinese-owned steel mill in England that is shutting down because of U.S. tariffs. I don't know how much politics is really at play here and how much of this is actual economics, but this just goes to show you this trade war, it's destructive, guys. There's like 2,700 jobs in the UK potentially going away because of a Chinese-owned firm at a British steel mill subject to U.S. tariffs. A lot of that steel is exported to the U.S. Look, this is gnawing at me right now. I got to look at what's going on. I just want to let you guys know what just happened. I get a text from Mish. It says, breaking, Coreweave lowering to $1.5 billion offering due to a tough market. All right, so thank you. First of all, thank you, Mish, for being all over this one. And apparently Mish also texted Gigi because out of the corner of my eye, I see Gigi right in front of my office window. She's like going like this, trying to get my attention. That usually means my sound isn't working or something is up. And she says, look at your phone. And I get this message from Mish. So Coreweave has reduced the size of their IPO to $1.5 billion. Let's see if they're talking about this on CNBC or anything like that, because this is just breaking news here. We don't normally do this, but hey, this is channel specific news. Nothing yet showing on CNBC's homepage that I can see. But so let's talk about this. All right, what's Coreweave doing here? Why are they doing this? Originally, Coreweave was going to IPO $4 billion. They were going to sell $4 billion at a $35 billion valuation. About a week ago, that was released reduced to about $2.5 billion. They're saying like 2 to 2.5, something like that. They reduced the amount that they're selling because they were worried about demand. And if this, okay, he's saying check Twitter DMs. I'm going to look at that. If this breaking story is true, which I haven't had a chance here, okay, It is in Bloomberg. We're going to shrink my big melon of a head. Let's do this. We're doing this in real time. F it. We're doing it live, Bill O'Reilly says. Coreweave is planning to cut the IPO size to $1.5 billion. That's funny. Martin Shkreli said yesterday on Twitter that the Coreweave IPO was 5x oversubscribed. Well, if it was oversubscribed, why would they be reducing the size of it? One of these things is not like the other. It's almost like Martin Shkreli's full of it. That's interesting. Coreweave intends to cut the size of its initial public offering to around $1.5 billion, said a person with knowledge of the matter. There's that guy again. In a sign of how the recent stock market volatility is hurting demand for even highly anticipated listings. The cloud computing provider plans to offer investors about 37.5 million shares at $40 a piece. So they're lowering the price also, according to the person who asked not to be identified because the information is private. That'd be down from an initial plan of 49 million shares at $47 to $55 each. That could have raised as much as $2.7 billion. Livingston, New Jersey-based Coreweave was at one time looking to raise about $4 billion from its listing and a target evaluation greater than $35 billion. That was before the broader stock market slumped and volatility dented optimism. Coreweave plans to announce the new terms to the offering later on Thursday. This is like 12 hours or 24 hours before they start trading. They're doing this. This is not going well. Semaphore reported earlier Thursday that Coreweave was planning to reduce the size of the deal without providing the new terms. NVIDIA-backed Coreweave was started in 2017 as a Atlantic Crypto. Okay, let's check the last paragraph. There's always something good here. The IPO is being led by Morgan Stanley, JP Morgan, and Goldman Sachs, along with 11 other advisors. Coreweave shares are expected to trade on the NASDAQ under the symbol CRWV. Okay, so nothing juicy in the last paragraph today. That is huge, guys. That's huge news. Coreweave is reducing their IPO, reducing the share price and the share count that they're offering. This IPO has already flopped, in my opinion. This is now the second time they've cut the size of it. They're limiting supply in order to support price, which means these guys, they missed their window. They should have IPO'd last fall, or maybe in December was the last time to do it. So, look, this is catastrophic for the AI bubble. Here's why. Here's why this is such a big deal, even though, you know, hey, a $2.5 billion IPO is now a $1.5 billion IPO. Okay, $1 billion. Why is that so big in the context of an $18 trillion AI bubble? The reason why is this shows retail investors have no appetite for this garbage. And because retail investors have no appetite for this garbage, that means institutional money no longer has an incentive to blindly pump capital into money-losing startups because they won't be able to dump those bags on retail investors. This is a signal from the market to the people who are burning money in this great game of Capex Chicken that we're onto your BS. You're not making any money. You're lighting money on fire, and I'm not going to pay for it. Now, a lot of this stuff is already sitting in pension funds and mutual funds, which sit in IRAs and 401ks. So in my opinion, the damage is already done to the average person. They don't even realize it. I don't think the average person realizes how much money they've already lost from this bubble. But when it bursts and their 401k starts dropping, they're going to realize it real freaking fast. And that's why I started making the videos about Coreweave back in 2023 to begin with. It was to prevent this bubble from inflating so freaking big to begin with. I was called a conspiracy theorist and a rando for it. Now this IPO is flopping because we finally got a look under the hood at Coreweave with that S1 filing when they were forced to show us just how bloody awful their books really were. And once people saw that, the few people who actually read it, that is, they're realizing, oh my God, this company is doomed. And so they're cutting the IPO. Wow. Thank you, Mish, by the way, for getting me that news. Thank you, Gigi, for knocking on the window in the middle of the live stream. That's huge, guys. I'm telling you, this bubble, it's bursting in real time. This is not good for NVIDIA stock. This is not good for Microsoft, Meta, Google. Sooner or later, people are going to realize all of these amazing CapEx numbers, that money, it's gone. They spent it on rapidly depreciating assets that there's not enough demand for. All these AI startups that have, our new large language model. Every single prompt that has ever been done on a chatbot has been at a loss. OpenAI, Claude, Character AI, it doesn't matter. Any of these silly LLMs, Copilot, every single one of them. Every time you ask it a question, it loses money. So how does that support demand for this endless build out of data centers? Well, it needs your money to keep going. And the market right now is saying you can't have it. And so this bubble is bursting in real time. Oh boy, buckle up, guys. Wear a helmet. That's all I can say. Thank you, Nashville Pasta Man, who's saying the WeWork of cloud computing, Coreweave. You know, I heard somebody else, I think it was Ed Zitron said that last week, that like almost verbatim, Pasta Man. And you're exactly right. What was WeWork? WeWork was ultimately they bought office buildings or they leased them long-term and they rented them short-term, right? WeWork was a real estate investment trust that harvested the arbitrage between long-term rates and short-term rates. That's all WeWork was. And they were valued at an obscenely high valuation. And of course, the company flopped. Well, what does CoreWeave do? They buy GPUs long-term and they rent them out short-term. They don't even own the data centers. They lease the data centers that the GPUs are in. So really, they buy GPUs and rent them out by the hour. It's an arbitrage opportunity between the long-term capital cost of a GPU and how much you can rent them out by the hour. Yeah, the WeWork of cloud computing. That is accurate, Pasta Man. Very astute of you, sir. And thank you for supporting the channel. Viv B gifted 10 Nobody Special Finance memberships. Thank you so much, Viv, for supporting the channel. Guys, if you got one of those memberships, welcome to the Melonheads, and be sure and say thank you to Viv. That was very nice of you, Viv. Mish says Coreweave has announced $1.5 billion offering now. Mish, I can imagine Mish is like trying to frantically get my attention while I'm live streaming. He's sending super chats. He's texting me. He's texting Gigi. Mish is that guy in the ear like, this just in, breaking news. So thank you, Mish, in the control room for everything you do for the channel. Thank you for getting my attention on that. And hey, Melonheads, everybody watching, thank Mish for also doing that because you guys got a better show because of it. Thanks, brother. Appreciate everything you do for the channel. Richard Bell says thousands new commercial white trucks sitting in lots for months, expanding big. Why? Government ? Martial law ? I haven't seen this, so I can't comment on how big the problem is, Richard. But look, we've got a Main Street recession that's been going on, right? 90% of the population not doing very well. In that 90% is a lot of small business owners. And small business owners are the people who buy those nondescript white commercial vehicles you're talking about. And so I'm not terribly surprised to see those sitting on the lots a little bit. That being said, those things, 25% tariffs, I don't know where those commercial trucks are made, but it's a good bet at least some of the parts are made in other countries. So even though they're sitting on the lot, they're making fewer of them, and there's tariffs being added to them. So I don't know what's going to happen to the price of those. They're probably going to keep going up. Martial law, no, I wouldn't go so far as to say martial law, to be honest with you. I mean, earlier in this decade, I might have bid on that one because there were some pretty crazy things that were happening to people by governments earlier in this decade. I think right now the public at large is a little bit too suspicious and too skeptical of government for something like that to be quietly put in place. Maybe in Europe, not here. Although, hey, man, I enjoy a good bit of tinfoil hatting as much as the next guy. But no, I don't think it's a government martial law conspiracy. I just think it's a small business recession is really the explanation for that. Thank you, Richard, for supporting the channel. And thank you, Viv B, once again, who says, did you see Germany demolished a perfectly good modern coal plant, was built in 2021? Insanity, especially with no equivalent replacement. How do they ramp up to go to war with Russia? Children in charge. Look, they are ramping up to go to war with Russia. I don't know how they're going to pay for it. You know, I had a story in the stack today. It got cut because of the Coreweave IPO being slimmed down. But Sweden has now announced they're going to spend 3.5% of GDP on defense spending, up from about 2.4%. So Europe is remilitarizing. I don't know how they're going to pay for it. I mean, the European bond market is in for a rude awakening. But sooner or later, there's going to be some kind of liquidity event, and the ECB is going to start spinning up the money printer. Inflation in Europe is going to come roaring back, absolutely roaring back. It's the only way they can pay for this defense buildup. That being said, the energy problems in Europe, you're right to point out, they're only getting worse. Remember, in that 500 billion euro plan, it was for defense and infrastructure, and the Greens got their 100 billion euros for unicorns and rainbows and solar panels. So they're going to tear down perfectly good coal plants. They've already shut down their perfectly good nuclear plants because a tsunami hit Japan. Anybody remember the last time a tsunami hit Germany? Anyone? But yeah, okay, shut down your perfectly good nuclear plants. Look, Europe's energy debacle is a self-inflicted wound, and Europe is going to have to deal with it. This defense spending and everything going on in Europe, they're going to have to live with it. There is clearly an economic separation happening between the U.S. and Europe right now. I don't know if it's permanent. Political tides in the U.S. change very quickly. We could very easily have another Democrat president in 3.5, 4 years, and he could cozy right back up to Europe, and they could all sing Kumbaya while robbing everybody via inflation once again. Maybe that happens, but for now, I think you're going to see this rift is growing, and I just don't know how Europe's going to pay for it, Viv. I really don't. Thank you so much for supporting the channel. Financial maintenance. What's going on, brother? He says, I'm sure crypto miners will pay $1,000 a GPU. The last time Coreweave got out of a business, they sold their Ethereum mining rigs to a company called TTM Digital, who promptly merged with a company called SysRX via a reverse triangular merger. SysRX stock rallied several %. Coreweave dumped their shares, and now that stock is worthless. These guys are financial engineers, and people who take the other side of the trade usually end up losing everything. So, yeah, maybe the crypto miners will pay $1,000 each for those GPUs, down from what, 35, 40,000 they cost originally. But it doesn't usually end so well for the crypto miners who do business with these Coreweave guys either. So, yeah, there's always that. Thank you very much, Financial Maintenance, for supporting the channel, sir. And Steve Woitis says, what's the market cap of AI stocks compared to MBS, CDOs, and derivatives circa 2007? Does history rhyme? I don't have those numbers off the top of my head, Steve. I can tell you, if you just go by like the S&P 500 from the bottom in, it was like October of 2022 to the peak that was earlier this year, the all-time high, it was roughly $18 trillion in market cap had been added. Don't quote me on that number, roughly 18 trillion. And almost all of that was Mag 7, and almost all of that was due to the AI bubble. So my number, it's probably lower now because we've had a healthy pullback here, probably somewhere closer to like 16 trillion now, but that's the size of the AI bubble, about $16 trillion worth of market cap. And that's assuming all these companies go right back to where they were in 2022 if the bubble bursts. And if the bubble really does burst and there is volatility and momentum to the downside, we could very easily go even lower than that. Now, how does that rack up against CDOs and MBS? I don't have the numbers for the 2008 comparisons, but I would add that we also have problems in collateralized loan obligations. We also have problems in MBS. See also that video I did with Melody Wright about people not paying their FHA loans for 57 months and still not getting foreclosed. We also have problems in autos. We also have problems in commercial real estate. Did I say that one already? We have problems in private equity, companies that can't IPO. And based on how this Coreweave IPO is going, private equity has even bigger problems now because they're not going to be able to sell their companies they've been sitting on for several years, which means they're going to come up with even more complex cockamamie ways to figure out a way to park that shit in your pension. I guess the point is all of these things combined much, much bigger than 2007, 2008. Now, do they all burst at the same time? Probably not. That's a pretty big assumption. But I would say the risk, the leverage is far bigger now. The question is, will the avalanche happen? Will it happen all at once? Will it be more controlled demolition? I don't know. But in my opinion, the cumulative risk, much bigger than it was during the GFC. And we have this inflation problem on top of that we didn't have back then, which means the way we responded to the GFC might not work as well this time around. It's going to be interesting, guys. Thank you so much, Steve Woitis, for supporting the channel. Once again, thank you, Mish, for being Johnny on the spot with that breaking news. That was awesome, guys. It's going to be an interesting couple of days. Thank you so much for the super chats and the support of the channel. Thank you also to my magnanimous melonheads on Patreon and YouTube. You guys are awesome. The links down below, should you feel so inclined. Don't forget that like button and the subscribe button on the way out for the algorithm. Hi, Mom. Hi, Dad. I love you guys. Until next time, everybody, live small and dream big.